A very warm welcome to the Trading Bell Show. What a year it has been, and that's what we wanted to focus on, to look at how the year has behaved, especially in regards to the markets. And joining us to help us more to understand this is Kevin Gigi, who is the head of equities at Genghis Capital, right here on my right. And my far right is Samuel Gishohi, NCBA Investment Bank. He's the head of business right there. Thank you so much, gentlemen, for coming. And I want to start by saying, this year has been what has been by many times unprecedented because of the nature of how it is, from the pandemic we are seeing, from the many things that we are seeing, political temperatures rising. But I want to ask you, maybe generally, this year, what has been your observation from where you sit? And maybe I'll start with you, Kevin. In brief, what would you say?
It's been a tough year. It's been a year in turmoil. We've seen quite some things that have really affected capital that flows into our markets.
Yeah.
So one, of course, there's the pandemic, which was carried on from last year. In addition to that, we've seen all these geopolitical instabilities. We've seen almost all our neighbors in an issue or two.
Yeah.
We've seen Uganda, invade DRC. We've seen the Tigrayans and Ethiopians. We've seen the Somalis protest after the election results. We've seen a coup in Sudan.
Yeah.
So you name a country, early in the year we saw, Tanzania's president die.
Yeah.
So I think it's only Kenya that has been stable in the region, but everything else around us has really played into affecting the capital inflow into our country. So it's been a tough year, and hopefully the next one becomes better.
Okay, and of course we'll be delving more, especially on your observation on the equities later on. But Samuel, I know you also sit in a desk where you see a lot of things. How has the year been on your end?
Well, it's been quite interesting.
Yeah.
2020, unexpectedly, we saw quite a lot of inflows, especially from the retail end, which I deal with mostly, because a lot of working capital became idle.
Yeah.
So against our expectation of, a lot of sell-offs to support business, it
and
was
by the way,
opposite.
I hope you mean 2021.
No, 2020.
2020.
I'm coming to 2021.
Okay, fine.
So, and that was when the market was at its lowest of low.
Yeah.
So 2021, we saw quite a bit of a recovery, especially on the large caps.
Okay.
But if you look at the the all share index, it actually increased more than the NSE index, which means across the board, there was a recovery.
Okay.
However, the large caps came back very strong, particularly the banks and telecom.
Yeah.
And around October 2021, that's where they peaked.
Yeah.
So, in as much as we are currently in a bit of a stagnation and a bit of a dip because of a lot of profit taking, a lot of people did laugh all the way to the bank because they took the brave step of buying into the market. So 2021 was a recovery year. Of course, we're going to an election year, so then there's a bit of a worry about that. But generally, 2021 has been a surprise.
Okay.
For lack of a better word, yes.
Maybe we could also attribute this to the advancements we have seen, like the vaccination processes that have come across and all that.
Absolutely, the reopening of the economy, of course, as the the COVID-related, lockdowns and curfews and all that stuff started to ease off, then businesses have started to pick up. But even in as much as businesses, because the economy didn't really pick up, the stock market itself remained a sort of haven. Now we are seeing a bit of flight of capital back into fixed income, which is bonds, the bond side of things, primarily because the stock market has sort of hit a bit of a peak and has dipped a little bit, and so people are putting a bit of money in the safe side, especially with the shorter end of the yield curve going up. Interest rates are going up. The government is quite hungry, so there's good yields there, which the investors are sort of taking advantage of.
Great. Before we just focused how we expect to see the year, next year to be, Kevin, I've seen, looking through especially this year from Q1s all the way down, banks were smiling because I was seeing a lot of good reports coming out, and I think it's alluded to what, we're just hearing about the recovery. I don't know, what's your comment, especially on the banking sector, because it looks like it's the one that was really smiling. I didn't see any banks saying we just hit some losses.
Yeah, the base was really low where the banks were coming from, and that is 2020, especially if you look at the full year. It was a full year under the pandemic. So having set the bar so low and the country becoming more reopened in 2021, I think it got to a people where guys knew, okay, this thing is not coming and going, it's coming to be with us. And so guys, some folks started taking preventative measures seriously. We started getting some vaccines into the country. We started training more people to be more equipped to deal with it. So generally there was that sense of relaxation, and guys just got back to their usual businesses. And now once businesses peaked, personal loan consumption's peaked, of course it was all smiles for the banks. So yeah, we've just from seeing, if you look at all the results, Q1, Q2, Q3, and now we're going all into full years, you'll notice that the banks have really reported improved loan book. Some are converting their government securities now into available cash to loan out to the public. And as much you expect, personal businesses, consumption, especially going into a festive period. We expect consumption, next year, early next year, again, kids are back to school. So all this is manufacturing and consumption, and that's all that is fueled by capital that is provided by these banks.
Gishwahe, I want to throw you as well in the bus there about the banking industry. What does this mean now for investors? People who are eyeing to, buy a stock or two. What would you tell them based on that?
Valuations are low. Which is a good thing. And the recovery is not yet fully round. I mean, if you look at the likes of KCB, which were around 55 before the pandemic, went down to 32 or 33 there, and have come back to the late 40s, 47, 48. We still have quite a bit of way to go. Valuations are low. The performance is very good. We are coming from a dividend drought. If you look at Equity didn't pay dividends, Barclays didn't pay dividends. So there's quite a few, I&M I think didn't pay. So there's quite a few banks who didn't pay dividends during the pandemic period. And my feeling, or our feeling, is that going into now 2022, we are going to see them come and use dividends as a signal. It's called a signaling factor to say we are back. Things are good now, because they are doing very well. So given that, I would expect that any investor is looking and seeing that the yields on stocks, if the share prices, which is now the capital gains, start to pick up in 2022, and of course the dividend yields are good. We are assuming 8-9%, probably even higher if they're going to be trying to make an impact on what they didn't do in 2020, 2021. It would mean a very good year for investors to be buying now. Now, the other thing I would say, going back historically, and it doesn't mean that this will be the case this election year, but every election cycle, for the last 4 election cycles, the market has rallied by more than 20%. Go and look at the graphs, the NSE 20, you'll see.
That's interesting.
So if that has been the case, and that's because during election years, investors are not looking to put too much in their businesses, because there's a bit of, and so the tendency is for this money to go into the stock market. My worry is that because COVID hit 2 years to the election, that may have already happened. So it may not necessarily happen, but it's a possibility that we could also see a rally next year.
Interesting, you've already jumped into how we're looking at the forecast. Kevin, I want to bring you as well in. What's your, from where you sit, what's on your crystal ball? What do you see 2022 being like?
I think
that look nice. Go on.
It's I mean, no analyst can comfortably predict what an election year could bring. I think it will be more of a surprise to us than how we were caught flat-footed with the COVID pandemic. So every election is different, and they all have their own dynamics. But I think first and foremost, and it's my prayer also, that it will be a peaceful election. I think the candidates are pretty clear, and it's my only worry is that it seemingly as the time goes by, it seems to be a 2-horse race, and that's when we have now issues. Of course, winner takes all, and loser won't accept defeat. So there are those concerns, and I think if you talk to every analyst, they'll tell you they're pretty concerned about that fact. But my prayer is that we've also learned from the previous elections in terms of foreign direct investments. It's foreigners tend to keep off from the market during that period.
Yeah.
And as such, we might see sort of like a temporary freeze on the stock exchange. Yeah, we are in a market where north of 85% we are driven by foreigners. You know, our market is not like Pakistan where 92% are local, so we cannot support our market by ourselves. So once these foreigners look out, and you know, to Gishohi's point is we have seen quite some inflows into the stock market, and that's also primarily because our regional neighbors are pretty unstable. So if anyone is looking to invest in an African fund, those African funds, and they're looking to invest in East Africa, they'll predominantly look at Kenya because we are heading the region. And we are not faring too bad when you're looking at the continent as well. We are a top 4 economy. I was just looking at the African Stock Exchange Association, ASEA, you know, and you'll realize Nairobi Stock Exchange is almost in top 3 on all statistics, you know. In terms
Quite
of
impressive.
Equity turnover, number of trades, all those metrics. So you know, you'll find your Cairo Stock Exchange over there, and these are 27 stock exchanges. You know, there are 28 stock exchanges in Africa. So these are 27, which means it's ex South Africa. So we are doing fairly very well. You know. So the next year will for me, I think we've learned from the past, and guys seem to be well positioned now. You know, guys have understood that we need to invest more than we consume, especially so that you don't get flat-footed. As Gishohi mentioned, the valuations are pretty impressive. You know, you're looking at KCB at 43, you're looking at equity at 47. You know, you're talking about Safaricom at 37. These are stocks you'd think rally to 43 levels. And with the benefits or the dividends of South Africa expanding regionally, we've not seen that here. Of course, unfortunately, because they went and expanded into, you know, we're talking about 50 billion Kenya shillings for a license fee, expanded into Ethiopia, then Tigray happened. So we've not really seen those dividends come to play. And I think once, and our president is playing a key role in advocating for peace on that Horn of Africa. I think once that settles down, we're going to see quite some dividends on the blue chip and more so on Safaricom.
Speaking of which, we'll be talking about how the blue chips are behaving, especially in the moving direction. And, you know, Gishohi, I want to end this part, but I want to ask you quickly, I have seen a lot of interesting things happening through the exchange this year, and I think we'll delve more on that from the day trading. I've seen even the bonds market getting a bit excited, corporate bonds as well being released, and we've seen 2 successful ones. I'd like you to comment on that, but right after this break.